Today, more than ever before, we have more uncertainty, more danger, and more risk being taken. Governments have decided that they are going to intervene at record levels, often helping out their friends, their colleagues, and the revolving door of business and government to ensure that their grip does not lighten up. Big changes have happened here in 2020, but we've only just begun. You came here for the truth, so let me unveil that for you. No time to waste. I want to get into the information right away. A lot to discuss here. Let's begin. IMF joins Powell and Lagarde urging governments to keep spending. What a laugh. I thought I would bring it to you. Central bankers keep up the push for fiscal stimulus at the IMF summit. Debt concerns rise, but the fund says it's too early to cut support. It's funny because everybody everywhere is saying spend, spend, spend. But does it really matter where the spending goes? Because I'm not sure they're paying enough attention. It looks like all they keep caring about is the stock market. Oh, don't worry. If we get the stock market up, we'll get the job situation working and everything's going to be a-okay. But you've already reduced interest rates down to zero. Some places have it negative. It hasn't worked, hasn't shown any validity, and yet they continue to do it. I'm sick and tired of it, but at this point, I'm just venting. Look at those central bank balance sheets. It is just, off the charts. Federal Reserve, this happens to be in a percentage of GDP, 40% of the GDP. ECB is at 60%. The Bank of Japan, 150%. And the Bank of England, 40% of the GDP. All of them have accelerated the amount of money that they have printed, and it has been non-stop. Take a look at what the Federal Reserve did. You could see how they started to just barely reduce the amount of money that they had on their balance sheet. The ECB, you could see it just slowly started to bring that down, but barely. The Bank of Japan continued to print money throughout the entire period, accelerating their balance sheet. But everybody in 2020 has decided to take the same page out of the same playbook and run with it. I got you an update on what's happening with the negative yielding debt. Right now, it is at $16 trillion. $16 trillion. The peak previously was approximately 17 trillion. So we're almost there yet again. It's always fluctuating, but this is it. What does that tell you about the value of money today? It should be a telltale sign. It should present this upside down world we live in, and yet everything continues on. Business as usual. And a little bit of humor to finish off the video. Nightmare US stock valuations driven by, quote, young, dumb investors, fund manager says. At present, investors are paying 22 times forward earnings to purchase stocks on the S&P 500, 50% higher than the 10-year average valuations across the index. You can read the quotes for yourself, but I wanted to make something clear. He was not saying that these companies are not worth money, they shouldn't be invested in, that they're not good. He's saying Microsoft, he's looking at Apple's and so on, saying these are great companies. But when you look at the actual numbers, they don't make sense. It doesn't make sense historically, and certainly fundamentally, there are serious problems. And when that happens, we tend to run into issues, corrections, and revaluations. That's what he's trying to point out, and I think that is wise to take in. Oh, Toronto, you never cease to amaze me. In Toronto, which UBS says has one of the greatest housing bubble risks of any major city in the world, I just covered this recently, by the way, if you saw that video, the average price reached $975,000 by the end of September, which is up, if you can believe this, 11% over the same period a year before. $1 million for the average home. $1 million. Now I'm talking about Canadian currency here, but still, this tells you how high, how exaggerated, how ridiculous the prices of homes are right now. But you can get, if you can believe this, you can get a home right now. It's very possible at 1.8% on the financing. 1.8%. You can get it lower, but from the big banks, you can definitely get it at about 1.8%. I just looked into this. Most of the banks are offering that level. This is ridiculous how cheap cheap the money is. And that's why people, they're looking at rent. All right, well, if I got to pay $4,000 to rent some place to get a home, well, it doesn't make much sense when I could pay that same amount and actually finance this $1 million. It all depends, of course, what the bank is willing to lend and so on, but today they're willing to stretch. I'll tell you that much. The exaggerated levels here never end up actually providing benefit to the average person. They think they're doing a good thing. They don't want to get lost out of the market, but the bigger the bubble gets, the worse it ultimately is. It happens all over the world. This is an article out of Fast Company, and they suggest real estate prices are about to drop 10%. Now, when we talk about this, it's not necessarily residential real estate, but they're going right across the board. To me, that's too broad. I think what we have to look at is the different levels of this. If you look at the different levels, you're going to see a very different picture because the residential real estate market looks a heck of a lot different than retail, for instance. If you are interested in reading this data, I'll have the link in the description for you to check out. I want to move on. Bankrupt chains hand over their keys to the lenders. This is coming out of restaurant business, and what we're looking at here are all different examples of these companies that are going under today. So many different organizations have simply gone belly up. It truly is unfortunate for anybody who's have started a business to struggle to get it going, particularly in those first few years. There's basically no profit to be made. It's all sweat equity. And then there's hopefully some level of expansion and expansion and expansion. And something like this comes around and topples it all down. So many jobs are affected by this. We're seeing it all across not just the restaurant industry, of course, but many different types of businesses. Here's yet more data on top of that. Really quickly, several charts to move through from Real Investment Advice. Take a look at this. In the stock market today, there have been many different examples of true exaggerated and undeserved heights. This just shows you year-to-date return on the left. The blue bar is the market weighted and the orange is the equal weighted. And I want you to focus particular attention as we move through these charts on this right here, and that is the top 5. This is where all of the money is concentrated. I'll move over to the next one. You'll see the same thing. Price to earnings, price to sales. Both of them are completely out of whack with reality. Just look at this. You're seeing the top 5 highest PE, and that's where all of the money is going. That's where the exaggerated levels are. Price to earnings are just simply off the charts. Price to sales, same situation. The top 5 highest price to sales. Year-to-date return is unbelievable. Just look at Apple's PE. I mean, this is absurd. 2020, it went from overvalued to unicorn land, okay? It is just, right here, it's showing you approximately 40. We're talking about the biggest company in the world, the same company that's getting bailed out by the Federal Reserve. It is a joke at this point, and not too many are laughing. Cumulative flows from U.S. active to passive funds 2008 to 2019, and it looks very clear the direction in which the money is heading. It's going towards passive funds, it's going towards ETFs, and it's moving away from actively managed mutual funds. That's a huge industry right there. And even these companies, if you look at all the different mutual fund companies, they are all setting up robo-advisors. So they have a team of programmers creating this robo-advisor. Money is going to flow through there, and so you do not need as many of these money managers anymore and the jobs that are associated with that, because there's a lot of administration, there's a lot of paperwork, there's a back office and so on, and you will ultimately need less of that as a result. Really quick, let's run through this. Northman Trader, the bull case, nothing matters. Not debt, not growth, not earnings, not layoffs, not valuations, not forward multiples, not tax hikes. Keep buying historic valuations because the magic money fairy will keep bailing us out. Wise words from Northman Trader. There's much more down all of these really good stuff if you want to check it out. I'm going to end the video there. If you found this informative, all you have to do to support me is give me a thumbs up. You just have to click one button on the way out. Thank you very much. If you want to learn how to sell stuff online, I'm talking about e-commerce, you can learn for free in my course. It's available at the amazongps.com. If you are interested in the financial system, learning everything from top to bottom, A to Z, you could do so in my 2 books. Check it out at the link in the description. If you want the audiobook instead, themoneygps.com. Hang on, where are you going? Don't go anywhere, don't click off. If you have not seen this video, you definitely want to. Click on it, I'll see you there.